I'd like to welcome everybody. My name is Rob Grimes. I'm a Senior Director in SAP, responsible for our European financial partnerships within SAP Ariba. I'd like to welcome Rob here, who's going to talk to us about various working capital solutions, the impact of late payments, and how payments are both, well, solutions and challenges in these times of disruption. So Rob is going to take us through a late payment story, and at the end we'll have time for a few questions. But for now, over to you, Rob, and enjoy the session.
Yes, thanks very much, Rob, and welcome to this session from Barclaycard with regards to late payments. So I'll start by saying in the UK, 50,000 SMEs go bust every year due to late payments. It's regularly cited as the #1 issue facing small businesses. And for those that want a definition, late payments are defined as payments that fall outside the due date of the contract or agreement. So if you've agreed 30 or 60 days and your customer pays you on the 61st day, for example, then that's classed as a late payment. Although this has got a sort of UK EMEA focus, similar statistics exist across Europe, and the numbers across the board are getting worse due to COVID pandemic. So I've been talking about late payments for the best part of 3 years now, with very much the view that we'd be talking about economic and macroeconomic disruption due to things like Brexit, which we've known is likely to have caused macroeconomic uncertainty, but certainly the pandemic is a global phenomenon and it's disrupted supply chains across the world. So some would argue with regards to late payments that in times of market downturn or uncertainty, holding on to capital as long as possible can be simply a strategy of survival. But I'd like to sort of make the case that late payments are bad for everyone. Firstly, for the suppliers. So, when a supplier delivers goods and services and is waiting for the money, the inability to sort of forecast cash accurately can have real significant impact on a business's ability to meet their liability. So liabilities include things like wages and their supplier payments, which if they're not being paid, can create that knock-on impact. And the overall sort of conclusion is that companies will start to hoard more reserves, put cash on the balance sheet, which therefore reduces their ability to invest in growth initiatives, things like hiring new staff, investing in new markets, or improving machinery that makes them more productive, or again, some of the messages you'll be receiving about digital transformation. It will stop those things from happening. And at the macroeconomic level, a country level or regional level, this can have really severe impacts on economies. A bit closer to home, that buyer and supplier dynamic is really important for innovation. Large organisations rely on innovation from their smaller suppliers, which can lead into a lack of sort of competitiveness if the supply chain just tends to be too focused on either too many SMEs or too many very large businesses. So, biggest impact on suppliers that we've heard, particularly when they're SME suppliers, is the worry about collecting money for products and services that have already been delivered. And it's shown that it's a huge driver of mental health issues for small business owners. Small business owners not taking holidays, small business owners not doing the business development activity that they need to make their business survive, because they are constantly phoning their customers to make sure that they were getting paid. And for buyers, it's also problematic as well. So organisations with financially weak or unstable supply chains could lead to disruption of the service. We've already talked about innovation and lack of innovation not being great for that customer or that buying organisation. Supplying and sourcing new suppliers in the event of a company failure can be really difficult and expensive. Other sort of associated problems with late payments are things like reputational damage, and we'll come on to some of government's response to late payments. And on the outside, it can be anything up to fines or loss of contracts as well. So for both buyers and suppliers, in summary, late payments are bad for the whole sort of financial ecosystem. So in the next slide, I just wanted to outline the government's response. So as you can see, here is what we call a tapestry. And we have recently engaged with an organisation and an individual called the Small Business Commissioner. So the Small Business Commissioner in the UK was set up in 2007, and their sole remit was to address late payments. So the Small Business Commissioner is a political appointment, and it's really in response to knowing that late payments, particularly to SMEs, are bad for an economy. It can impact GDP and economic prosperity. So we engaged with the Small Business Commissioner to ensure that we really understood all the issues around late payments, because we wanted to help raise the profile of this issue, and we believe we're part of the answer in solving it as well. So as well as the appointment of a Small Business Commissioner that addresses late payments, there was also new legislation and something called the Payment Practices and Performance Reporting, I think commonly known in the UK as the duty to report, is mandatory reporting that companies have to now provide, which is publicly available information that states what is the state of the payment practices within an organisation. So the reporting that they have to give includes things like the number of average payment terms, the number of invoices or payments that they made which were late. So it really gives a whole picture of how organisations in the UK are paying their supply chain. And this is really important for transparency, because I know many of you as suppliers do research on new customers, and we'd absolutely recommend you, for those that operate in the UK, to go onto the government website and look up your prospective or new customers to see how they're currently paying their suppliers. If they're currently paying their suppliers, if they've currently agreed payment terms of on average 30 days, but 60% of the time they're not paying them to those 30 days, you can be sure that you may be able to negotiate 30-day payment terms, which as a supplier is good, it's best practice from a supplier perspective. But if you're only going to be paid to 30 days at 60% of the time, then you may choose not to accept those terms and look for better terms. And then the third element of the government's response was companies to be barred from bidding on public contracts. So there is in the UK a voluntary code called the Prompt Payment Code, and signatories to that code need to pay 95% of their invoices within 60 days. And if they are barred from those prompt payment code, you can be chucked off it. Then you're now barred from public contracts. So these are just some of the examples in the UK how governments are responding to the sort of the pandemic of late payments. In each country, we've done studies across the EEC, and each country across the region is also implementing similar policies. So anything from mandatory fines through to some of the initiatives that have been rolled out in the UK. So in essence, governments are looking to take a hard line on late payments and to try and stamp it out. Okay, on the next slide, this is just an illustration of how late payments can be disproportionate to either the industries or the type of suppliers that you're paying. So this slide here illustrates that for smaller payments, smaller companies, late payments disproportionately impact them than larger, well-capitalized businesses. So in a pandemic or in a sort of more political area of macroeconomic uncertainty like Brexit, what tends to happen is in recessions more broadly, smaller businesses start to have a reduction in the availability of credit from mainstream lenders such as banks. And with the reduction in credit or the ability to borrow money, that then can in turn lead to an increase in the cost of finance for those smaller businesses. So, for large businesses, they can get access to cheap money most of the time, even during sort of macroeconomic uncertainty, because they are well capitalized and seen as a low credit risk. And so what we're saying is with late payments, it's large businesses that are well capitalized and can get access to money very cheaply. They should be the one that's trying to push money into the economy to keep driving GDP, rather than what happens at the moment is they're the ones that start to push out payment terms or even hoard cash or make late payments to small companies that are least well capitalized to afford it. And in turn, over time, that leads to increased prices because the cost of finance will eventually be built into the cost of their goods and services. That's straightforward economics. And so what we would say is if there are large businesses that are well capitalized, and they are a strong credit risk option for many mainstream lenders, it's those that should be moving that money into the UK economy and paying their suppliers quickly. The next slide really illustrates that this isn't a consistent picture across all industries. So we already know that small businesses are disproportionately impacted by late payments, but there's also an industry view here. So in some high achieving industries, such as retail, air transport, and food wholesale, they're achieving on average 30 days payments or less. And it's called DSO, which is days sales outstanding. So they've done the sale, they've provided the goods and services, and it's how long they wait to be paid. So DSO of less than 30 days is really strong. But unfortunately, only 16% of the industries outlined in this report from Mastercard are currently achieving those 30 days or less. At the other end of the spectrum, the left-hand industries, as you look at the slide, they have DSO of 60 days or more. So 46% of all industries have DSO, day of sales outstanding, of 60 days or more. So more than 2 months to wait for the money once they've delivered goods or services. And it becomes a bit more acute after that. Things like industries such as aerospace, defence, construction, and telecoms, they're all averaging over 90 days, so they're waiting 3 months. And there are some outliers as well. Organisations that sit in advertising, they're typically asked to wait 200 days, so well over 6 months to be paid for the goods and services and the services that they're delivering. So there are disproportionate industries that have been impacted by either extended terms or late payments. So on this next slide, it just outlines the relationship between days sales outstanding and the margins that a company can enjoy. And this is where we start to look at card acceptance and the industries where card acceptance in a B2B context is most prevalent. So the Mastercard study, and Mastercard being our partner, outlines where margins are strongest and days sales outstanding exceed 60 days is where the business case is strongest for suppliers to accept payment by card. But we understand that card acceptance is not for everyone and not for every industry. So if you are collecting, money in under 30 days, you don't suffer from impairment or bad debt, and your average transactions are very high, say over £1 million. The cost of acceptance can be prohibitive. However, for many industries where they're commodity type sales like janitorial, furniture, catering, protective equipment, those sorts of commodity type items in those industries, that's where the average transaction value tends to be quite low. The invoice volume tends to be very high, and that's where the strongest business case is for card acceptance. And accepting payment by card from your customers can be a differentiator. And I'll just look into the next slide, which is the benefits of card acceptance. So currently, globally, over 40 million suppliers currently accept payment by card, with the majority of those organisations accepting card payments from consumers. However, card acceptance in a B2B context is growing in popularity, and the COVID pandemic and macroeconomic uncertainty is driving that increased levels of acceptance. So there are 4 pillars as to why an organisation may accept payment by card, and I'll just explore those now. So firstly, it's managing risk. In a period of recession or downturn, many organisations, particularly small businesses, may not make it. And one of the highest reasons is for administration, or insolvency is that their customers are not paying them. So yeah, we started the presentation with 50,000 UK SMEs, so small to medium enterprises, go bust each year. A few years ago, there was a large construction firm in the UK that went bust, owing £1.2 billion to their supply chain. And that supply chain was mainly small SMEs who had signed up to 120-day terms. That was a red flag in the first point because of the extended payment terms that they were asking their suppliers to sign up to. And when they went bust, they took a whole supply chain and whole swathes of the UK construction industry with them, because small businesses just cannot withstand, a large impairment or a large insolvency. They cannot wear the sort of bad debt that's needed. So the domino effect of one business going bust and then taking the supply chain, that's just one example. And through the next 6 to 12 months, unfortunately, there will be further insolvencies and closures, and we've started to see that in particularly in high street retail. So when you're managing your risk, you need to look at your customers and think, I'm providing goods and services to them, on payment terms that are reasonably lengthy. You are exposing yourself to some impairment. So there are insurances like trade insurance that are out there, but that might not cover all of your book. And so accepting payment by card, might be a good option to provide that universal coverage. And yeah, as I say, bad debts and managing that sort of bad debt is going to be critical for many organisations over the next 6 to 12 months. So that's the first pillar. Second one is to get paid earlier. Cash is king. It's a phrase that we use regularly, and although interest rates across the UK and the Eurozone are at historic low levels, the actual real cost of money remains moderate, if not high, depending on how well capitalised you are. So we have a supplier calculator which we can populate with our customers and suppliers' details to tell us what is the business case for card acceptance. And there's a specific line in there about working capital. So what is the real cost of you being paid 30, 45 or even 60 days earlier from some of your key customers? How can you use that money to either invest in growth opportunities or just to protect and shore up your finance and balance sheet? So getting paid earlier, getting the money in, having the security of those confirmed funds within your bank has huge value to your treasury teams. So that's the second pillar, and probably one of the most important. The third pillar would be, in effect, better customer relationships. We've got a number of suppliers we work very closely with that accept payment by card, A, because they've been asked by their customers, but B, because they believe it's the differentiator that helps them retain their customers. One of the key elements of many of our supplier relationships in a B2B context is use as a retention tool. So we have one construction firm in the UK that currently offers 50 card acceptance after offering 45-day terms themselves. So transactions that take place, say, through the month of August are billed on the 1st of September, and those invoices fall due at the end of September. At that point, the supplier accepts payment by card because they know that their customers would then benefit from a further 56 days from Barclaycard. So that organisation, just from card acceptance, and paying their card acceptance fee, will be able to give their customers up to 100 days extended terms, but they're only really on the hook to provide 50% of that. So from their perspective, it's a retention and a sales tool to help them win and retain existing customers. And it can also help differentiate where you're a commodity and say there's 3 stationery providers and you're competing on many orders with those other 2 competitors. Being able to accept payment by card, being easy to do business with, and all the benefits of payment by card for the buying organisation, can help grow that wallet share. And then finally, it can help, in some examples, attract new customers. So many of our buying organisations will put, we want to pay by card in RFPs and requests for information. So being able to say that you can accept payment by card can attract new customers. And then finally, the fourth pillar would be to run more efficiently. many accounts receivables processes are very inefficient and costly to run, and so those processes, whether it's credit control or the collections processes, they do come with a financial hit. Being able to accept payment by card at the point of delivery of goods and services, can really help streamline that collections invoicing process and VAT allocations processes. You can also know that on the buyer side, you're helping your customers to become more efficient. So when many of your customers come to you and say, what are the initiatives and innovation that you can help us to become more efficient, particularly if it's a type supplier commodity where there's thousands of invoices per annum, we know that we can reduce those invoices and help streamline that buyer-supplier relationship, particularly for low-value goods and services or low-risk goods and services. And so that's the 4 pillars of why you should accept payment by card. I'd just like to come on to the working capital slide, which is just one of the benefits of accepting payment by card for both buyer and supplier. So here we see days payment outstanding and days sales outstanding, both at 45 days. If you've got a payment term of 45 days, then it's a nil-sum game. The moment the money leaves your customer's account and it arrives at yours, you've both got 45 days. If we look at the next example, where on day 45, a virtual card payment is made, or a card payment is made more generally, the customer receives their money on day 45, but the buyer benefits from a further 15 days until we bill them. On average, it can be up to 30 days later. And then 28 days after that, we collect the money. So again, you can see, like the example we've got with our construction firm, we've got the situation where you're being paid on day 45, but your customers are able to extend their terms to day 88. And that is a really rich and useful retention and sales tool. So then there's the final scenario with a 45-day invoice term, but in this scenario we are going to initiate the payment much earlier in the cycle on day 15. So in this scenario, the supplier gets paid on day 15. This could quite easily be day 1 or day 0. So the supplier is paid on day 15. 15 days later, on average, we would then invoice your customer. So they're being invoiced on day 30, and then we give them a further 28 days after that. So they are settling with us on day 58. So you've secured your early settlement, yet your customer is secured extended payment terms. So this is the scenario where there is a win-win for both buyer and supplier. You're being paid early as the supplier, but you're extending the terms of your customer, hitting all of the different pillars that we outlined on the previous slide. So in essence, what we're saying is the flexibility of when you initiate that payment as a buyer, or when you take that payment as a supplier, can be flexed across any point of that 45 days, depending on the value. So, our view is that by inserting 56 days into that buyer-supplier relationship, both organisations can benefit, and there would be zero reason for late payments or any Machiavellian behaviour between that buyer and supplier. So that ends the presentation for today. There are obviously lots of other ways that Barclaycard can help both the buyer community and the supplier community, and we'd love to open a conversation. So my contact details are there. I'd love to hear from you from email, and I can refer you to the correct team depending on whether you're a supplier or you're a customer, and we can go through a consultancy exercise to help you understand not only what the cost of accepting payment by card is, but also outline the benefits. So we'll be able to give you that tailored business case and really look at the arguments for card acceptance versus other payment factors like SEPA payments or GBP payments, such as BACS or faster payments. So we're competing with other payment types, and we look forward to talking to each of you about your individual payment innovation. So with that, I think I'll hand back to Rob for some Q&A.
Yeah, So Rob, that was fantastic. Thank you very much. I thought it was really interesting to see the fact that you've done so much analysis on late payments, on the timing of payment. So it's not just about the settlement, you're really taking into consideration the timing of that payment. And also I thought was interesting is the partnership you have with MasterCard, which is a very understandable, straightforward partnership. And it kind of makes me think is, can you explain the partnership with SAP and with SAP on the Ariba network and how that partnership works and what the value is to our supplier community and our buyer community, just, to share with those on the call?
Yeah, absolutely. So we've got two partnerships in effect with the SAP family. SAP, from a payments out perspective, have partnered with Barclays. So where we've integrated some of our payment capability, whether that's bank transfer capability or whether that's virtual cards, your virtual edition of the chip and pin card or the purchase card. So we've integrated our payment capability into SAP Ariba. So from a payments out perspective, Barclays are really working very closely with SAP Ariba, understanding what are the requirements for that buyer community, what are the challenges around reconciliation, around automation, and around working capital, and how we can solve those issues using the card rails effectively. And then on the other side, we've got a payments in partnership with SAP around cloud commerce. So we've integrated some of our card acceptance capability into the SAP cloud commerce platform, which provides broad benefits for those that already accept payment by card, whether that's in a B2C or business to consumer sort of environment or in a B2B environment. Both of our integrations, and our partnership is based on trying to make our customers' lives easier rather than a complex project or integration. We've done that hard work for you ahead of time with the SAP product team, so that from wanting to go ahead to implementation, we really shorten those project timelines and take the complexity out of these implementations. So we're delighted to be working with SAP across all modules and elements of that SAP ecosystem. We're looking at other use cases as well outside of SAP Ariba and outside of cloud commerce to see what other value we can bring by working collaboratively within that ecosystem.
Yeah, and I guess, Rob, actually, it's good to say that it's not just a UK, although Barclaycard and Barclays Bank is a very famous, well-known UK organisation. This is a European, if not global, solution, isn't it?
Yeah, absolutely. So on the payments out perspective, our strategy is very much regional. So we focus on, supporting our European customers first and foremost. That's where our contracting and our currency capability is strongest. From a payments in perspective, we've got broader capability than just EMEA, and we can support a broader set of customers. So again, my email address is at the bottom there. Irrespective of where you're based in the world, we'd be delighted to hear from you, and we can put you in touch with the right team, depending on where you're based and what your requirements are, whether that's serving the consumer and accepting payment by card, or whether that's serving a business customer, and again, whether that's in the UK, EMEA, or further afield.
Fantastic. Okay, so a follow-on question, actually, coming back to your presentation, is you talked about payments and the different payment methods, and typically the buyer determines how they want to make that payment. But I think what you're saying is that there's actually value of a discussion between both buyer and supplier to figure out what's the best payment method for both sides, both parties. Can you share with us how the supplier community can influence their customers on how those payments could be made?
Yeah, absolutely. So you're right. In many cases, the negotiation around payment terms is normally done at contractual level. And, at that point, the buyer is in the strongest position to negotiate terms and conditions. However, we think that there is, a different lens that you can take on payments. As we said before, we've got, this construction firm that we're working with and many other suppliers in a B2B context that we're partnering with to offer products to their customers so that they can see the benefit. So in that example of the construction firm, they're using payments from the card networks to sort of support their sales efforts, their retention efforts, and their new business wins. So that has a sort of slightly different dimension. And again, we can do that with any of the suppliers that's listening today. If you'd like to contact us, we can go through an analytics exercise with you, looking at your customer base, understanding whether SMEs or large corporates, understanding what the payment terms are, and helping you build that business case to accept payment by card. And the assumptions that we can put in there will be done in partnership with that supplier. So that supplier can say, what their cost of capital is, so that we can understand what the benefit of being paid early is. We can understand their margins, so we can put, what would an extra 5 or 10 or 15% growth mean to those individual organisations? Because again, accepting payment by card can increase, wallet share between that buyer and supplier. And again, it means we can be more proactive. We've got large sales teams across Europe that can deliver on both this supplier and customer promise. So if you've got 300-400 customers or 3,000 or 4,000 customers across the EMEA, and you need a partner to go and change how you are paid, for you to really scale the innovation within your receivables processes, then we're a great partner to work with. So again, I encourage you to get in touch.
Thank you very much for that, Rob, for taking time to share with us some of your insights. And definitely, please, people reach out to Rob. It's very interesting, the fact that it's supporting analysis on both sides. So there's value and benefit, and that analytics, I think, is something you should take advantage of in the future. So the partnership's here to stay. The network is growing. Services will build. So please reach out.
Yeah, and we're really excited to continue to work with SAP to provide value to the organisations that are on that Ariba network, and all the innovation that you're bringing to that network. So thanks for the partnership.
Yeah. All right, Rob. Well, have a good day, and we'll see you.
Thank you.